Decentralized finance, also known as DeFi, uses cryptocurrency and blockchain technology to manage financial transactions. DeFi aims to democratize finance by replacing legacy, centralized institutions with peer-to-peer relationships that can provide a full spectrum of financial services, from everyday banking, loans, and mortgages, to complicated contractual relationships and asset trading. In today's video, we are going to show you what is DeFi. Without further ado, let's begin. Decentralized finance, DeFi, is an emerging financial technology based on secure distributed ledgers, similar to those used by cryptocurrencies. In the U.S., the Federal Reserve and Securities and Exchange Commission define the rules for centralized financial institutions like banks and brokerages, which consumers rely on to access capital and financial services directly. DeFi challenges this centralized financial system by empowering individuals with peer-to-peer digital exchanges. DeFi eliminates the fees that banks and other financial companies charge for using their services. Individuals hold money in a secure digital wallet, can transfer funds in minutes, and anyone with an internet connection can use DeFi. Centralized finance versus decentralized finance. Centralized finance. In centralized finance, money is held by banks and third parties who facilitate money movement between parties, with each charging fees for using their services. A credit card charge starts from the merchant and moves to an acquiring bank, which forwards the card details to the credit card network. The network clears the charge and requests a payment from the bank. Each entity in the chain receives payment for its services, generally because merchants must pay for the use of credit and debit cards. All financial transactions are overseen in centralized finance, from loan applications to a local bank services. Decentralized finance. Decentralized finance eliminates intermediaries by allowing people, merchants, and businesses to conduct financial transactions through emerging technology. Through peer-to-peer financial networks, DeFi uses security protocols, connectivity, software, and hardware advancements. Wherever there is an internet connection, individuals can lend, trade, and borrow using software that records and verifies financial actions in distributed financial databases. A distributed database is accessible across various locations as it collects and aggregates data from all users and uses a consensus mechanism to verify it. Decentralized finance eliminates the need for a centralized finance model by enabling anyone to use financial services anywhere regardless of who or where they are. DeFi applications give users more control over their money through personal wallets and trading services that cater to individuals. How does DeFi work? Decentralized finance uses the blockchain technology that cryptocurrencies use. A blockchain is a distributed and secure database or ledger. Applications called dApps are used to handle transactions and run the blockchain. In the blockchain, transactions are recorded in blocks and then verified by other users. If these verifiers agree on a transaction, the block is closed and encrypted. Another block is created that has information about the previous block within it. The blocks are chained together through the information in each preceding block, giving it the name blockchain. Information in previous blocks cannot be changed without affecting the following blocks, so there is no way to alter a blockchain. This concept, along with other security protocols, provides the secure nature of a blockchain. DeFi runs on blockchain. Blockchain and cryptocurrency are the core technologies that enable decentralized finance. When you make a transaction in your conventional checking account, it's recorded in a private ledger, your banking transaction history, which is owned and managed by a large financial institution. Blockchain is a decentralized, distributed public ledger where financial transactions are recorded in computer code. When we say that blockchain is distributed, that means all parties using a DeFi application have an identical copy of the public ledger, which records each and every transaction in encrypted code. That secures the system by providing users with anonymity, plus verification of payments and a record of asset ownership that's nearly impossible to alter by fraudulent activity. When we say blockchain is decentralized, that means there is no middleman or gatekeeper managing the system. Transactions are verified and recorded by parties who use the same blockchain through a process of solving complex math problems and adding new blocks of transactions to the chain. Advocates of DeFi assert that the decentralized blockchain makes financial transactions secure and more transparent than the private opaque systems employed in centralized finance. Risks and downsides of DeFi. DeFi is an emerging phenomenon that comes with many risks. As a recent innovation, decentralized finance has not been stress-tested by long or widespread use. In addition, national authorities are taking a harder look at the systems it's putting in place, with an eye toward regulation. Some of the other risks of DeFi include no consumer protections. DeFi has thrived in the absence of rules and regulations, but this also means users may have little recourse should a transaction go foul. In centralized finance, for instance, the Federal Deposit Insurance Corp reimburses deposit account holders up to $250,000 per account, per institution, if a bank fails. Moreover, banks are required by law to hold a certain amount of their capital as reserves, to maintain stability and cash you out of your account anytime you need. No similar protections exist in DeFi. Hackers are a threat. While a blockchain may be nearly impossible to alter, other aspects of DeFi are at large risk of being hacked, which can lead to funds theft or loss. All of the decentralized finance's potential use cases rely on software systems that are vulnerable to hackers. Collateralization. Collateral is a thing of value used to secure a loan. When you get a mortgage, for instance, the loan is collateralized by the home you're buying. Nearly all DeFi lending transactions require collateral equal to at least 100% of the value of the loan, if not more. These requirements vastly restrict who is eligible for many types of DeFi loans. Private key requirements. With DeFi and cryptocurrency, you must secure the wallets used to store your cryptocurrency assets. Wallets are secured with private keys, which are long, unique codes known only to the owner of the wallet. Uses of DeFi. Peer-to-peer financial transactions are one of the core premises behind DeFi. A P2P DeFi transaction is where two parties agree to exchange cryptocurrency for goods or services, without a third party involved. In DeFi, P2P can meet an individual's loan needs, advantages, and disadvantages of DeFi. Pros. Decentralized applications allow individuals to transfer capital around the world. A decentralized app, also known as a DApp or dApp, operates on a blockchain or peer-to-peer network of computers. It enables users to engage in transactions directly with one another, as opposed to relying on a central authority. Investors' ability to generate income. The platform enables depositors to lend its native stablecoin, DAI, and earn interest as they would with a centralized bank. Maker generates revenue via its stability fee, which is the interest charged to borrowers, as well as taking a cut on every liquidation. High level of security. U.S. securities law implies that because governance tokens offer potential for appreciation and are initially issued by a DAO's founders, they may be securities. As securities, they would face much stricter regulation, including identity checks of token holders, which would undermine the user experience. Cons. Participation in DeFi is complex and not easily understood. Smart contract auditing is required with all DeFi protocols. Blockchains cannot access off-chain data. As a result, a third party is required to provide real-world data to that identical blockchain, which makes data centralized and vulnerable to centralization issues. High risk of fraud and scams. Rug pulls, also known as scam tokens or DeFi scams, are not just abandoned crypto projects, as the traditional definition of a rug pull would suggest. Rug pull tokens are explicitly programmed to steal from retail investors. High level of volatility. A higher volatility means that a security's value can potentially be spread out over a larger range of values. This means that the price of the security can change dramatically over a short time period in either direction. The future of DeFi. Decentralized finance is constantly evolving. It is unregulated and its ecosystem is riddled with infrastructural mishaps, hacks, and scams. Current laws were crafted based on the idea of separate financial jurisdictions, each with its own set of laws and rules. DeFi's borderless transaction ability presents essential questions for this type of regulation. So guys, let me know your thoughts down in the comment section below. Give this video a thumbs up for more interesting content, and don't forget to subscribe to the channel for more awesome content. Have a nice day, and I will see you in the next video.